So there is an incentive to be a bright student.
Yeah, that was quite amazing actually.
But you say stories can be very dangerous when it comes
Yes.
to investing.
Human beings are creatures of the story. Market is not a human being.
How did you plan to jump into entrepreneurship? Because not every academic scholar takes that path.
So people told me don't even apply. In the end, I got 2 extra marks for my IIM gold medal. Who are you? You are a nobody. But in no time, our work was in Forbes, Fortune, Business Week, Wall Street Journal, front page, Barron's, everywhere.
That easily.
And also there's a mental block because when we were growing up, there was no option to invest globally.
Yeah. Devina Mehra, one of the most acclaimed finance experts of the country, is not just another name in the world of finance. She is a trendsetter who has redefined how India looks at global investing. She is the founder and managing director of First Global, which has footprints in India, London, and USA. A gold medalist from both Lucknow University and IIM Ahmedabad, Devina brings rare academic brilliance along with decades of real-world market wisdom. She is also the author of Money, Myths and Mantras, the ultimate investment guide, where she dismantles conventional market wisdom and makes a compelling case for thoughtful global diversification. Welcome to the show, Devina.
Thanks for having me and thanks for a very kind introduction.
So, Devina, my first question to you would be about your own life trajectory, considering you were an excellent scholar. And from there, later on, you started First Global. So how was that path? How did you, plan to jump into entrepreneurship? And because not every academic scholar takes that path. So what sort of pushed you to do that?
You're right. I mean, not only was I academically oriented, both my parents were academics. Both my parents have been professors. So, and very far away from business because I grew up in Lucknow, which was not at all a business city. So when I came to Ahmedabad, I didn't even know what a share was. I didn't know what debit and credit was. I had no idea of finance or investing or markets. And out of IIM, I joined Citibank. So I was in investment banking, then later on in corporate credit. And beyond a point, I was not very happy. So I was looking for a change. I did not know what that change would be. And definitely, I didn't know that this would be the path because this career did not even exist. When I graduated from IIM, there was no career called securities research.
Right.
It did not exist. So we didn't even have a course on it because that career didn't exist in India. I mean, it existed elsewhere, but it didn't exist in India. And I was looking for a change. You'd be surprised, I even went and met what is now the Chhatrapati Shivaji Museum director. What are the interesting things I can do?
Wow.
I went and met the Economic Times editor. What are interesting career options? Because I was looking for learning. I mean, that was always my driver. That what is it where I can learn. And so this just came, and it came because of 2 reasons. One was Dr. Manmohan Singh's liberalization budget, where he said the market would open to foreign institutional investors. And so I said, now the market will professionalize because till then, they were only the old-time stockbrokers. There was no professional research. So that was one. And the other was, at that time, there was no NSE, there was no SEBI, only Bombay Stock Exchange. And of course, there were smaller regional exchanges. So Bombay Stock Exchange advertised that they would give 71 new memberships to professionals. And that was at 55 lakhs, which of course in the early 90s was a very large amount. But it was a quarter of the market price. The market price of a BSE membership was 2 crores. Wow. So people told me don't even apply. They're not going to give it to you at a quarter of the market price. They will give it to their whatever bhai bhatijas and all
and those
that.
with huge pockets.
Yeah, and not just that, because BSE was a brokers club. It was mostly Gujarati and Marwadi. Said you are a total outsider.
So a lot of nepotism in there.
Yeah, very much. So said don't even bother applying. I know a lot of people didn't even apply. They wouldn't get it. But I always say that manifestation of goals and visualization of goals at that time. the BSE card was right there, that this, if you get it, your life is made. So they took 2 years over it, managed to somehow get the money also. And of course, they tried not to give it. In the end, I got 2 extra marks for my IIM gold medal. And that pushed me over the cutoff.
Wow. So there is an incentive to be a bright student.
The dots connect in hindsight, as they say. So that's where it came in useful. So I got the BSc card. So in the 90s, I was running a securities and investment banking firm. So basically institutional broking, where my clients were some of the largest funds in the world, all the funds that came into India. And we became very large in that space in the 90s. And towards the end of the 90s, the kind of, it wasn't really a pivot, but the additional part was that we went global. Again, against all advice, against all precedent, we were not just the first Indian, we were the first Asian members of the London Stock Exchange, other than the Japanese, in 1999, so 26 years now. And then a year later, we got the NAST membership also, and we have been covering global stocks now for more than quarter of a century. And the most heartening part in that whole journey was people told me, you can't do it. And even if you do it, who's going to listen to you? Because you have all these veteran Wall Street firms which have been around 50 years, 90 years. Who are you? You are a nobody. But in no time, our work was in Forbes, Fortune, Business Week, Wall Street Journal, front page, Barron's, everywhere, just on the quality of the work. So
amazing.
So that was quite amazing, actually.
Yeah, and at that time when you don't have social media,
nothing.
It's not democratized.
And you don't know the journalists here. At least you might also personally know the media. There you did not. You were only sending out your work.
Yeah.
And so the next change was to move from, this is what is called the sell side, where your clients are the fund managers. The next move was to become a fund manager or an asset manager. So in 2015, we started global asset management, and 2020 is when we started the PMS, or portfolio management services, in India.
Okay, lovely. That's an amazing trajectory, Devina. So if you were to explain to a lay investor what First Global does, how would you do so?
So right now we manage money. So in India, we do not yet have a mutual fund. We have a PMS, what is called a portfolio management services, which is discretionary portfolio management. And also for smaller investors, we put a kind of our recommended smart basket on the small case platform. So with one click, if you agree with it, you can execute the whole basket. So that's our recommend, because there are a lot of people who said that we don't have the 50 lakhs to start a PMS account. How do we get your skills for that? So that is what we do in India, broadly speaking. And in globally, we have both portfolio structures as well as an actual fund. That's a mutual fund, overseas mutual fund, not an Indian mutual fund. But we have an overseas mutual fund. We also, of course, for more sophisticated investors, we have more specialized products also.
So you usually have retail investors or corporate investors? Or
so this would be mostly HNI, family office, that sort of thing. Though, as I said, for India, we have the small case for the smaller investor. Overseas also, because for me, this is a cause that Indians do not invest enough globally. Right. We have a product, we have a investment avenue where you can get a portfolio which invests across all countries and across all asset classes, that starts just as $10,000. So that's less than 9 lakh rupees. Whereas in a private bank, you will not get anything like that for less than $1 million. So I really wanted to make it accessible for the common Indian, because Indians are still invested 90-100% only in India.
Correct. Even the ones who are sort of mature investors,
yes,
they have not yet explored global markets,
yes,
because they don't see a way to explore global markets that easily.
And also there's a mental block, because when we were growing up, there was no option to invest globally.
Yeah.
It was not allowed.
Right.
So
now the familiarity is not there.
Yeah. And now the limit is very generous. So that LRS, liberalized remittance scheme of RBI, allows you to send out $250,000 per person per annum. So family of 4 can send out $1 million every year. That's like nearly 9 crore rupees. So basically, you can send out as much as you want. I mean, unless you are a large size family office for a normal human being, you can send out as much as you want. But still, in your mind, you are not still thinking about it.
And you also speak about storification bias. So, storification as a term for us marketers is very dear because that is what we do. We build narratives, we help brands build narratives. Every ad has to be basically a story.
Yes, exactly. Something I write about often, that the effective ads are all stories.
Exactly.
Because, I mean, if I tell you that in Thane district there are 5 lakh malnourished children, you will not contribute to the charity. But if I give a visual, either a picture or a video of one family which is starving, you are more likely to
donate.
Donate.
Exactly,
So human beings are creatures of the story.
Exactly.
I mean, that is actually one thing which is common across all civilizations, across geographies, and from like hunter-gatherers to the most sophisticated, is that we remember stories, we don't remember data, we communicate through stories, we teach through stories.
Absolutely. So my whole, in fact, career is built on helping people create those stories. But you say stories can be very dangerous when it comes to investing. So if you can elaborate on that and any example of that.
Yeah, so the market is not a human being. So the market is not interested in how carefully you have crafted the story. So the story is in your head.
Right.
And one of the issues with stories is you tell it enough times, you start to believe it also.
Right.
So that's the danger of a story. So a well-crafted story, yes, when there's a human being to be convinced on the other side, that's very effective. So sometimes it is not so effective the way we say it, that we believe in data and we are driven by data. It sounds very dry and drab, and even large banks, for example, one of them had written to us saying, tell us which are your high conviction ideas and why do you like them. And we actually sent them a 4-page note explaining why we do not have high conviction ideas, why we are against high conviction ideas, because high conviction ideas is what? That you have bought into this narrative. You have married that story.
Right.
And then it becomes very difficult to let go. If you look at Warren Buffett, for instance, one of his favorite stories had been Coke, that is this great brand that generates so much cash, very predictable, all of that. And because he told that story too many times, he did not get out of it. So for 30 years, Coke was a huge underperformer relative to the S&P, even more relative to Pepsi. But he just held on to it because, as I said, you sometimes craft stories and you fall in love with them yourself. Or you might craft stories which might have an element of truth and maybe an element of untruth also.
But don't fund managers play a huge role in this whole storytelling and narrative building? Because from the time I remember, from the time I have started investing, I've always found every finance expert to be very bullish about the market. I don't remember a time when, the finance experts used to say that, play safe or do not invest. Everyone is saying that cycles will come and,
India
keep
growth
investing.
story.
Yeah, there's
India
a whole
growth
India
story.
growth story running and everyone has sort of bought into it. So how do we even sort of, know whether a story is true, not true, whether to buy into it?
Ultimately, you have to look at the numbers. I mean, for example, if I go back to, let's say, 2008-9, that was another time when there was a boom in infrastructure companies. And it was that if India has to progress, infrastructure companies have to progress. And at that time, we had not yet started our own fund management. So this was one of the frustrating things where you went to all the fund managers and explained to them, look at this, the return on capital for all these companies is plummeting, and this is not going to end well. This is sometime the market will realize how poorly actually the companies are doing, that to show whatever profit growth they are showing, they are raising capital all the time. That time nobody listened, and then those stocks crashed, and for the next 12 years that was a very disastrous sector. So that's what the stories entrap you. As I said, that and no matter how good the story, if the numbers don't hold, eventually it catches up with you. Like for example, HDFC Bank is one call of ours that everyone remembers, that you picked HDFC Bank in 1996. What people don't remember is that we were the first and probably the only firm to have a negative view on HDFC, the parent, in the late 90s. And HDFC was the most loved stock in the Indian stock market. I mean, all the foreign institutions just loved it. At that time, we had started with, first we had 25% limit for FII, then it went to, I think, 35, 40, something like that. So every time that limit would open, HDFC was one stock where the limit would get over on the first day. So we had a negative view on HDFC again based on the numbers. Not that it was a bad company, but they were raising money too frequently, and again return on capital was coming down. And people said, are you crazy? How can you have a negative view on a company that everybody loves so much, where people are waiting to buy it? Right. Said ultimately you cannot defy the numbers, and that is what happened. For 5 years the stock remained at the same price. So the correction happened through time. It did not, fall, but it was the same thing that 5 years you got zero returns. Yeah. So ultimately the numbers catch up with you, and ultimately if the story holds, then again also it should come through in the numbers. If you're saying the management is good or the brand is good, then it will be captured somewhere in the numbers that either your market share is better, your pricing power is better, your margins are better. Somewhere it has to be captured. So that's what I used to tell my analysts. So whatever is the story you are telling me, tell me through the numbers.
Exactly. So coming to the current US and India trade friction, you say that it does not work basis fairness, but it is based on the relative bargaining power of a country, which is true for almost all countries which are practicing trade. So, where do we stand currently, considering that, media is terming us as a global superpower already? So do we, what sort of, where is our position in this bargain, the whole bargaining equation?
दिल को बहलाने को गाले भी ख्याल अच्छा है. No, we are a long way from holding all the aces. So especially when you're dealing with essentially a bully like Trump. So there he's not looking at long-term relationships or anything like that. There it is very much who has more power. And we haven't really built that kind of power on an international stage. We of course are, as it is, imports are limited except for IT services. And also we have never thought in terms of moving up the value chain, of controlling either raw materials or technology or anything.
Right.
We have remained at the kind of foothills.
So in terms of numbers, we still have
not just the numbers. Also, I look at China, how strategically they have played everything, that they have to control all the mineral resources around the world, and not just in Asia and Africa. It is true even in South America and even the Arctic Circle. And if you are buying a made in Italy bag, it might still be made by the Chinese, because there are whole townships of China out there, so which gives you the made in Europe, but actually made by Chinese. And also, even 5 years ago, they had identified these 7-8 high-tech areas like neuroscience and biotech and electric vehicles, semiconductors, and they worked systematically towards controlling all of that. The R&D spend of China is 20-25 times what India spends.
Right.
So, if we have to become a real power, then we have to think strategically, plan, and actually execute. I mean, right now on manufacturing, in spite of our saying make in India, our manufacturing as a percentage of GDP is down where it was in 1960s.
Right.
So this is like, just slogans don't help. You have to execute.
Absolutely. So you were talking about making changes at the implementation level if we are to hold any power on the global stage. What role does education play, considering sort of we are not yet there when it comes to R&D, but we don't have that much of research focus when it comes to education, starting from primary to going to the college and the higher education level. Then when it comes to finance education, we've hardly been taught the basics of finance in school or in college until we get to the job stage. We hardly there's anything in the curriculum. So what do you think about that?
Yeah, in fact, just today I posted that health and education are the cornerstones of the economy. I mean, people think that this is some sort of freebie thing to be talked about, but unless your workforce has basic education and is healthy, gets the right nutrition, you don't have the wherewithal to take your economy forward. So these things are the very basic building blocks, and we have not been spending enough on it. And the states that did focus on it went ahead. Tamil Nadu is a very good example. It used to be one of the poorest states in the nation, but they were among the first to really get serious about the midday meal scheme, and therefore the education and health improvement. Now it is the least poor large state. I mean, the only states ahead of it are small states like Goa. Among the large states, it's now at the best situation. So that pays off over a period of time. It is not something that pays off in 1 or 2 years, but definitely that is something we need to focus on. And also on the mindset. For example, we did have technically educated people, and we had all these IT services companies with so much of cash. They still did not invest in R&D to move up the value chain, and you continue to do what you've done for the last 25 years, essentially. So,
Okay, so coming to some of your, opinions that have come up time and again in your talks and in your columns, you call the buy blue chips stocks and then just hold a myth. So, as an investor, I also used to do that because that's the easiest thing to do. You just, buy a trustworthy company and then forget about it and maybe look at the stocks 10 to 20 years later. But you say that that's a wrong way to invest.
Because you don't know what is a blue chip at a point in time, whether that will remain a so-called blue chip. So if you look at the original Sensex list, there were all these companies which were, look at the industries. It were industries like textile, paper, shipping, or for that matter, the makers of Fiat and Ambassador, Hindustan Motors and Premier Automobiles. There were all these groups which used to be at one time the leading groups, Mafatlal, JK, Singhania, Modi's, Thapars, which all of Scindia. So all these have become far less relevant today.
Yeah,
So that was, and they were not fly-by-night companies. They were all, when the original Sensex was formed, I looked at the list of 30. All those companies had a very long history. The only company with a relatively short history was Indian Hotels. Other than that, all the 29 companies had very long histories. And yet this is what happened. If you look at how the Sensex and Nifty list has changed over the years. So many fashions have come and gone, so many companies from Reliance Power to Suzlon and Satyam to Yes Bank have been part of these indices and gone out. At one time, I think 10 out of the 30 Sensex companies were PSUs. Then in between, people forgot that PSUs were listed and, you could invest in PSUs. Yeah. At one time, there were 0 banks and financial institutions in these indices about 25 years ago. Now they are the highest weight. Yeah. So all these fashions come and go. So when people say, oh, if somebody's grandparents had invested in Hindustan Lever or HDFC Bank, that this is what they would have compounded. But that's not the only thing they would have invested in. Yes. So people actually bring sometimes their parents or grandparents' portfolios, and most of them are just full of junk.
Yeah, right,
So you remember the successes, you forget all the failures. The banking alone, people talk of that compounding in HDFC Bank and Kotak Mahindra, and they forget how many banks actually went belly up. Right. Times Bank, Global Trust Bank, Centurion Bank, half a dozen public sector banks. Yes Bank went through a problem. Yeah. So many banks went through major issues. So you are only talking of the ones that made it in a sense. Yeah.
True. For somebody who's a lazy investor, or somebody who has, a daytime job and has other priorities, is not too adept at investing, what would your strategy be? Somebody who is interested in wealth creation but is a bit lazy about investing.
Yeah, so actually a lot of people just think that I must know everything before I start. In fact, I was talking about this to someone on the way here, that too many people just freeze and don't do anything. So first get the broad asset allocation right. And it may not be 100% optimal, but it is 80 to 90% optimal if you get that right. So don't put 100% in equity, even if you're young, even if you're in a good job. So have some in equity, but whatever you might need in the next 8 to 10 years, don't have it in equity. So have fixed income, have some gold, real estate you might anyway have. So, but don't be on extreme ends of the risk spectrum. So don't be all in fixed deposit, don't be 100% in equity, be somewhere in the middle, but start investing. So again, don't delay. You would have all seen those calculations that if you start investing at 24 versus 30 versus 34, you have to save so much more. Even if you can't save a lot, start. Even if you can't save 20% of your salary, save 5%. But say of the increment, I will save 70%. Save and invest. So, and as I said, get the broad allocation right. Within equity, it's fine if you are in multi-cap, flexi-cap kind of categories. Don't try to get into themes. That's the other place people go wrong.
Okay. So not just auto sector, not just banks.
Yeah, not just small cap. That's where people go wrong. And I often say that if you want a quick rule of thumb as to where there is excess in the market, look at where all the thematic funds are being launched. That's normally near the peak of that theme, not the beginning of that theme.
Right, because it's already ripe and people can see it.
So it is easy sell for the asset management company that now is the person on the street also knows about it. Defense stocks में मेरे friends ने पैसा बना लिया, मैं रह गया. तो अभी defense का जो fund आएगा, I will put money there. That becomes the kind of mindset.
So अभी AI stocks का funds start launching.
So that's all. I mean, see, buying
better be careful.
So-called new tech is anyway a very dangerous game. I wrote a column about this that first of all, you don't know which technologies would succeed. There was a technology columnist who retired after 40 years, and he had a long list of all these so-called promising technologies, from Google Glass to Apple cars to 3D televisions, which were launched with so much fanfare and which went nowhere. Now, also, how long will a technology take to succeed? For example, electric vehicles, if you ask people, they'll say it's a very recent technology. The first electric car in India was launched 24 years ago.
Right.
So I used to meet renewable energy companies back in the 90s. So how long will it take to succeed? Which company will succeed? Right now, if you look, for example, this year Tesla's sales volumes have declined, whereas the Chinese companies' volumes have gone through the roof.
Right, and which will be able to sustain the growth for so long.
And even if a technology succeeds beyond imagination, who makes money out of it? Like, if you look at the 20th century, automobiles and aviation, these are two technologies which fundamentally changed how human beings live. But they have both been a graveyard of companies as far as investors are concerned. Investors have not made money in these industries. So that's one more additional thing. AI itself, it is not that whether AI will be adopted, whether people will be able to make returns on their investments, because AI requires a lot of investment. Will people pay enough for them to make a return on that investment? And this is an investment with very quick obsolescence. So, for example, about 25 years ago, there was that internet is taking over the world. So you need, and the thing you can invest on is that people who are laying the infrastructure for internet. So which was the company? The company called Global Crossing, which laid all these undersea cables for the internet, which are still being used. But the company went bankrupt long ago.
Right.
So it's not never so simple. So people don't have this thing of which company will be successful a few years later, even in an existing technology, let alone a very new technology.
Right. But talking about technology now, you also use technology when it comes to investing, and AI is the buzzword, at least in finance investing. So how useful is it, and how do you leverage it, and how do you still have human in the loop to ensure that the analysis is not just a hallucination?
Yeah, so we are not, for us, it's not a buzzword. I actually started the PMS only after we had the system, and not because it's fashionable, not because it's available, but there's been a fundamental change in investing. And an analogy I give is that if you look at hockey, for instance, if I ask a group of Indian youngsters that why should hockey be our national game when it is now 50 years, we've just started winning a bronze. So why is it our national game? And it's our national game because from 1928 to the mid 70s, India dominated hockey to the extent that not only did we win the Olympic gold, there were 2 Olympics where there was not one goal scored against India in the entire tournament from the beginning to the finals. And then suddenly, how did हम लोग जो बोलते हैं ना hero से zero कैसे हो गए? Because the playing field changed from grass to AstroTurf. So the skill set required change. So in investing also something so fundamental has changed that up until, let us say, the 90s, early 2000s, the edge was an information edge. Information was difficult to get. Even an annual report was difficult to get. There was no Excel around. So I really loved going around the countryside and meeting companies, even going to plants. All of that was great fun. But now the game has changed because information arbitrage is gone. And this is the change is not just in India, everywhere. In the last 20, 25 years, everywhere in India, in the world, laws have come which say that you cannot have differential information sharing. So even if, let us say, you have an analyst meet, the transcript of the analyst meet has to be on the website. So now the skill set required is that there is data, everyone has data.
Overload of data.
Yes, so there's masses of data. So the skill set is not now getting the data, it is analyzing masses of data. And that's where AI and machine learning come in, which is how to analyze so much data. Like globally, we look at 20,000 odd stocks and you have to look at so many factors per stock. So how do you look at it? And not just that, you have to look at it on a consistent basis, without bias, without randomness that human beings bring in. And that's where the machine helps you. However, you need the human expertise also, both to program the machine and then also not to use the machine as a black box, but as an input. So that is where the human, people ask me, do quant methods work in investing? And I say, if I ask you, are financial models made in Excel good or bad? You would say that's an absurd question. Excel is a tool. What are you doing with that tool? What are you putting into that tool? So machine learning is exactly the same. It is a tool. It depends on what you're doing with it.
True.
So what is going into the system, that will determine what's the output.
Yeah, true. So considering so much has changed, like you said, from how you used to gather information in the past to how it's done now, what is one investment advice that you would have given, say, 20, 25 years back, but now you say that's not valid now? Is there something?
Yeah, so it is just that it evolves. So as I said earlier, you could reasonably, maybe in our grandparents' time, you could reasonably say that you might unearth gems which nobody had heard of on a consistent basis. Now that because the data is there and because so many bright minds are in the market, you cannot play to only win. So one thing which I say is investing is a loser's game. So there is an old article by Charles Ellis which is about that there are winners' games and losers' games, and games change. So, tennis, for example, at the Grand Slam level is a winner's game. You have to play brilliantly to win. But at your local level, it's a loser's game. Your aim should be just to keep the ball in play, and the other person will make enough mistakes for you to win. So now you have to play not to lose. Not to lose doesn't mean that you don't book losses. You book the small losses so that your capital does not take a big hit or a big loss. So that's how the game has changed. That now your focus has to be on not losing.
And this famous story of yours where you spotted Amazon when everyone else had sort of dismissed that stock, and so today, if you first maybe just elaborate that story in brief, and then my second question is a follow-up question to that today, if you had to pick one company today which is Amazon like misunderstood, maybe what would that be?
Okay, so Amazon was actually fairly simple. When we talk of numbers, uh, cash flows is one thing to look at. So it's not just profits and margins and sales growth. So we were always very cash flow focused, and that was the first time Amazon had made very substantial cash flow. So this is the last quarter of year 2000. So we had made this recommendation in, I think, March 2001 or so. So, the last quarter numbers had come in and it had made, I think, $220 million of free cash flow. For the first time in its history, it had made substantial cash flow. And to our mind, it was kind of out of the woods now. There was no risk in the company. Whereas for some reason, at that time, everybody was writing about how close Amazon is to going bankrupt. There was actually, that same week, there was a cover story on Business Week saying will Amazon go bust. Every single analyst who had earlier been very gung-ho on Amazon was now saying this company is a disaster. There was no other buy on the street, and we had a strong buy.
Wow.
And Jeff Bezos actually wrote us a mail saying thanks for the support, because ours was the only buy.
Wow.
But people ask me this. I mean, what you ask me exactly sometimes on social media also, people tell me that you found HDFC Bank, you found Amazon, which is that one stock I can buy for my baby and forget for 25 years.
Yeah.
So I said, like, nobody has this crystal ball. At the most, when you're recommending a stock, you can say it will double or triple. No one knows the trajectory for 20 years or 25 years.
Right.
That is simply not true. If anyone in the history had ever had that, there would have been some investor or fund manager, whether Warren Buffett or Rakesh Jhunjhunwala or someone whose even 50% picks were multi-baggers. But nobody has that track record of even 50%, let alone 90% picks being multi-baggers.
Right.
So you have to choose as per a system, but still you will have to buy 25, 30 stocks, some of which are definitely going to be duds. This much also I can tell you. And some will give you normal returns. And if you've chosen well and you have the luck with you, you might get 2 or 3 multi-baggers, but you will not know in the beginning which are going to be those stocks. I mean, Rakesh Jhunjhunwala did not know that he would make all his money in Titan, CRISIL and Lupin. He bought so many dozens of stocks along the way. Every time you'd meet him, he would be talking about some stock, how wonderful it was, but so you wouldn't know that in advance.
Right. As today, if one goes on YouTube or one goes on any platform for that matter, there is a wave of finance workshops happening. Everybody wants to learn how to invest, how to multiply, which is maybe a good thing. But there's also, a phenomena where a lot of people, instead of doing their regular jobs or businesses, are fully investing their time and energy into multiplying their wealth or investing in different trading and all of that. So when it comes to generating wealth, how do these two methods compare? If somebody is just banking on how other people are making value, basically investing in businesses, versus somebody who's maybe running their own business, or you're doing a simple 9 to 5 and maybe trying to climb up the corporate ladder. How, if we look at them, if we sort of de-link both of them and compare, how does it compare?
So when I said that don't be on either risk end of the risk spectrum, so don't be all in fixed deposits and PF, and don't say that I will become a day trader or a crypto trader or something like that. And I see that sometimes with people straight out of college, or even people who are retiring saying now I will become a full-time trader.
Yeah.
So all these are risky things. And there is this comment by this very famous Wall Street trader, Bernard Baruch, who was a trader 100 years ago. And then, of course, he went on to do many other things. And he said that the problem is not with the stock market. The problem is that people think that this is this magical place where you can make money out of nothing and very quickly. So that's the problem. And also remember that even Rakesh Jhunjhunwala, for example, people used to say that you made your initial capital through trading and you tell people not to trade. He said, I smoke, but I tell my children not to smoke. And also at a time when people like him made those money in trading, there were a lot of inefficiencies in the market. I was talking to you about all these multiple stock exchanges. Prices in one stock exchange used to be different from another. So even a simple arbitrage was available like that. Now many of those things are gone. So it is And if whoever is telling you on the internet that they have this magic formula is misleading you. This much I can tell you. I mean, there are all kinds of good courses available. Even university courses are available to understand the basics of finance. That's a different thing. But to say that somebody has this magic formula where you can make 1% on every trading day is fooling you. Because anyone who can make 1% on every trading day can make their money 7.5 times in a year. If they start with 1 crore in 5 years, they'll end up with 20,000 crores. I mean, why are they hawking this system to you and asking you to pay 10,000, 20,000, 40,000 to learn this? If they have this magic formula, go ahead and make that money.
Right.
So, and every time SEBI cracks down on any of them, all their money has been made through selling these courses, not on the, no one has this track record of trading. So, I mean, if you are going to play so fast and loose with your money, as I said, like Diwali pe Lakshmi maa ki puja hoti hai, to khali puja mat karo, samman karo really of your, it's your own hard-earned money.
True. There are these course peddlers who've actually made tremendous losses in the share market. At the same time, they're just earning from these courses.
Of course. That's a model.
So you've seen several cycles, crashes, and also recoveries. What is the one principle that has stayed with you throughout?
See, one part is to the extent of your equity allocation, most of the time it makes sense to remain invested. So get your asset allocation right, which also means, of course, global diversification as well as asset classes within India. But after that, don't keep tinkering around with it. Normally, we don't take cash calls because we all understand the risk of being invested in the market, that you can take a hit. But there's also a risk to not being invested in the market. So since Sensex started, suppose you had missed out on the 10 best days, you would have missed out on 2/3 of the return. So instead of 100 rupees becoming 75,000, you would be at 25,000. If you missed out on 30 best days, which is not even a day a year, because I'm talking 40 odd years, you would have missed out on 90% of the return. So the only time we actually took a cash call was the COVID crash. So I actually tweeted on March 2 that something very strange is happening. And but then within 3 weeks, we reinvested because again, there is a risk to sitting it out. Once market had a vertical fall, we said like now there will be a bounce back. So what also happens is often people say, oh, I'll wait for a correction to invest. But when the correction comes, they don't invest. I was looking at my February interviews because my book had just come out. So I'd done a series then. And everywhere I'm saying the same thing, that if you're waiting for a correction to invest, have you invested? Yeah. And of course, the market bounced back from there. So that's the thing that you normally freeze. On the other hand, do have on individual stocks always have stop losses. So you have to.
Right. You believe in the 7% rule that if it's falling below 7%, then you sort of take out the money.
7%? Where does the 7% is like too little. I mean, normally your stop loss should be in the range of maybe 25% from the top, not 7%. 7% you'll just get stopped out.
Yeah, usually isn't it? But I don't know where I read this rule as a
normally it's somewhere around 20 to 30% at least. So, I mean, on the average, let's say 25%. But not from your purchase price, from the high. From after suppose you bought it at 100 rupees, doesn't mean that your stop loss forever is 75 rupees. So if it goes to 200, comes to 175, you remain invested. It goes to 300, comes to 250, you still remain invested. But if it goes to 400 and then comes down to 300, that's when you get out.
Yeah, okay. Got it.
So I have a chapter on my book on when to sell, because I said everybody tells you when to buy, but this is a real question. Also, when you are talking to a fund manager, everybody has very nice, rosy stories about how they pick stocks. Right. But how do they manage risk and when do they sell?
Exactly.
So you have to look at how deeply they have thought about that side.
Because every time I'm about to sell a stock, I'm like, let's just wait it out. So I just don't sell often. Like this is what happens with me. So I'm sure this is what happens with a lot of people.
Right.
And which may be a very wrong strategy, in fact. So what is, one reason for anybody to pick your book and read? What is it that they will get from it?
It is a distillation of all that I've learned in 30 years.
Wow.
And I've tried to make it accessible to the newcomer and yet have something interesting for the seasoned investor also.
Nice. Interesting.
So it's really my teaching genes.
And if there is one investing myth that you wish to erase from everyone's mind immediately, what would it be?
Oh,
If there is.
there are many. I mean, we talked about buy and forget, and as I said, don't be on either end of the risk spectrum. That's the one thing which I find that people lurch from one end to the other.
We'll do a quick sort of a lightning round. In a crisis situation, would you prefer cash or gold?
Cash.
Do you usually have contrarian views, or do you believe it's safer to go with the consensus?
I have never believed in being with the consensus, but on the other hand, you should not be contrarian for the sake of it. I've never had a problem being in a minority of one. I told you about Amazon.
Right. Blue chip versus hidden gems.
Oh, this is, you have to take a balance. It can't be just based on category.
But how do you even find a hidden gem now, considering there's so much information everywhere?
Yeah, I mean, hidden gem is just a thing that maybe a company which is still at a relatively initial stage compared to what is called a blue chip.
So it's always a retrospect, basically.
Yeah.
Right? Yeah. One book that shaped your investing philosophy.
One book is difficult, but more than just investing, overall thinking, I would say Daniel Kahneman is my hero and my guru. So both his books, Thinking Fast and Slow and Noise.
Your one-line investing mantra.
Do first principles thinking. Think for yourself.
Great. And data or gut?
Data.
Perfect. Great. Thank you so much, Devina, for being on this show, for sharing so many gems with us right now. And I just loved this conversation. So many takeaways for me as well.
Thank you. Thank you for having me. I enjoyed it.